Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I talk through some of the trends underneath the surface of the market that investors may want to understand. Much of the market's move higher has come from lower quality, smaller companies. As a result, more higher quality companies are now in the value segment of the market compared to the same time last year. In addition, many are saying value stocks are back, but in reality, value stocks really aren't beating small caps or low quality companies. Understanding these trends and the drivers of returns are something investors should understand and pay attention to. Thanks for listening. We hope you enjoy this discussion.
All right, you wrote a couple interesting articles over the past few weeks that we wanted to kind of use as, I think, the basis for the discussion today. And the first one that we're going to talk through is this article you wrote, Value Investing is Back, ! Or is it? And it was a good piece because you sort of started with the idea, and there's this narrative, and it's to some extent it's largely true that value stocks, since March of last year, or maybe even more so since November, have really kind of sort of come back very strongly. But what you, I think, wanted to do in the article is talk about how, while value has come back, there are other things also happening underneath the surface that are, largely driving the performance of stocks. And so maybe with that, I'll let you sort of kind of outline what you were going after here, and then we can get into some of the specifics.
Yeah, when we look at anything that's happened in investing, one of the most important things to do is to not just understand what has happened, but also to understand why it's happened. And the reason is because in terms of what's going to happen going forward, if you don't understand what drove your returns in the past, then you're going to understand less about what might happen going forward. And so there's been this popular narrative, if you look at small cap value type ETFs, many of them are up over 100%, 150% or something like that off the bottom. And so there's a popular narrative based on that value investing is back. And that, we've seen this resurgence in value that all of us have been waiting for the past decade. But when you look behind the scenes, the reality is a little bit different than that. And so what I wanted to do with the article is I wanted to take a look at what actually is driving these returns and sort of compare that to what people think is driving the returns. And then, maybe do an analysis to sort of better understand what has happened in the past and what that can tell us about what's going to happen in the future.
Yeah, so you kind of highlighted a few popular smaller cap ETFs in here, and you kind of used our factor tool to show how much exposure they had to something like size or quality, and you sort of use that as the basis for showing that the performance of these ETFs is very different. But when you actually look at their underlying holdings and where they have the most exposures, you actually would see a lot of differences as well.
Yeah, if you look at the ETFs with the best performance off the bottom, they have basically, or the value ETFs with the best performance off the bottom, they have three common characteristics. One is they have a lot of exposure to value. Two is they have a lot of exposure to size, so they own small and mid-cap companies. And three is they have a very negative exposure to quality. So you're talking about, people like to call them junk stocks, but low-quality stocks, whatever you want to call them. So those three exposures are common among the best-performing value funds off the bottom. And so then the question becomes, what of that is driving performance and what part of that is not driving performance? And so to better understand what these value funds have done off the bottom, you want to sort of break down each of those factors individually and say, which of these have been driving performance and which of them haven't. And so that's basically was my point with the article, is when you start doing that, what you realize is that a lot of this performance has been driven by low quality. So low quality stocks have been doing well across the market, whether they were cheap or not. And then a lot of this has been driven by size as well. So small and mid-cap stocks have been doing well across the market, whether they were cheap or not. And so when you back out that value exposure, you still get the same types of returns you've gotten in these value funds. And so what that tells us is that a lot of this return, if not most of the return, has been driven by low quality stocks and small stocks.
Yeah, you had this, you made these portfolios that you tested using our data, and you were able to, I think, go back to March 5th you went back to you went back to March of last year, and you ran it through basically early March of this year, and you showed that stocks with the most value exposure in this sort of hypothetical portfolio, produced a return of 145%. But then the low quality portfolio that you ran and tested returned 132%. So, not much difference, only 12 percentage points of difference versus value. But then you showed the size portfolio. So the portfolio that held the smallest stocks, was up 180%. So clearly, like you said, it was a lot of the size effect and sort of these low quality stocks were contributing to the performance of value.
Yeah, so if you want to understand what's driving returns, one way to do it is what you just said, which is basically you isolate each factor on its own. And so what I did is I took the highest rated decile, or the 10%, the highest rated 10%, using each factor in our database. So I took the cheapest 10%, I took the smallest 10%, and then I took the lowest quality 10%, and I looked at them individually. And then I said, well, if value has been driving all these returns, I should see value outperforming the other two. And as you said, what you saw is the opposite of that. Small size has actually been the best performer. So if I just bought stocks because they were small and didn't consider anything else, that actually produced the best return over this period. And then second was value by a small margin. And then third was low quality companies. So when you break it out, you start to realize that a lot of this return has not come from value. And another way to do it is if you look at some of the popular ETFs out there that use a high quality value strategy, what you'll see is, they have a little bit of outperformance off the market bottom, but they don't have a lot. So introducing that high quality company, that Warren Buffett type factor into the equation has reduced your returns a lot off the bottom. And so what that tells us is that basically low quality and size have been driving this more than value has.
And we'll get into that quality piece in a minute, but that, I must admit, I do get a little bit worried when, I think about the fact that it's been a lot of these junky stocks, these low quality stocks, which, by the way, maybe they're the ones in terms of the reopening that will get the biggest benefit, assuming we get growth going again and the economy recovers and we expand, and it's looking, likely that is probably going to happen. But it's just, when I think about low quality and the smallest stuff driving, a lot of the returns, part of me is like, is this thing just going to fall apart at the seams if growth doesn't come through, or if the market maybe doesn't, recover economically based on how well people think it is. So, I don't know if that's just my view on it. I'm not positioned to benefit if that happens in any way, shape, or form, but it's just more like something I sort of think about when I look at data like this.
But that gets back to my original point, which is by understanding what drove the returns in the past, we can start thinking about how we want to position ourselves in the future. And so if you have the concerns you have, which are very legitimate concerns, as someone running a value fund, maybe someone wants to think about, all right, I need to add higher quality value stocks to my portfolio now, because I know that what's driven the return in the past is sort of this low quality small cap thing. Maybe I want to get away from that. If I think that's sort of something that could fall apart, maybe I want to get away from that. Maybe I want to move in a different direction where I'm getting more exposure to, or similar exposure to value, but maybe not having those other exposures. And so that's why it's important. A lot of us who are quants tend to have this this thing we do where we break down the historical returns or something, and then we show that maybe they were, the returns were not as quality as you think they were because, you thought you were buying value, but you really were buying those other things. And, that's really a stupid thing to do. And it's not what we're trying to do here. It's what we're trying to do here is more say, if you got great returns in the past, that's great. But by understanding how you got those returns, you may be able to position yourself in the future, in a better way, understanding what drove those returns in the past and understanding what you think that means for what might drive returns in the future.
Yeah, that might be a really good point, because if you think about the way that this bull market might mature, as you come out of the depths of it, you get a lot of the really good performance out of the deepest value stuff, out of the low quality stuff, and small caps too. But as you kind of come into the more mature cycles of a recovery, you I think tend to get maybe historically better performance out of higher quality stuff. And one of the points that you made in that quality article is I think you went back and you looked at within the value universe what percentage was high quality in March of last year and what percentage is high quality in March of this year. And what your data showed was that, there's much more high quality in value today than there was a year ago. So that's, I guess, to your point, the high quality is looking to be on sale here.
Yeah, so the next logical step after you say, all right, low quality value stocks have driven this rally is, well, what does that mean for the future? And, one of the things you can look at then is say, all right, well, now that that's happened, now that these low quality value stocks have gone up so much, what's left behind? What do the current crop of value stocks look like? And that's what I was trying to do in the article. And I did it in two different ways. One is I sort of looked at one of these value ETFs that's run up a lot and said, what do risk exposures look like now after the run up? And they look very similar to what they did before, which is, you still have a decent value exposure, not as much as you had. You still have a lot of low quality exposure, and you still have a lot of size exposure. And then I looked at QVal, which is the Alpha Architect Quantitative Value ETF by our friends at Alpha Architect. And what I saw there is basically the exact opposite of that. What I saw again is a lot of value exposure. And I think it was actually more value exposure than some of the low quality funds, but I saw a very significant exposure to quality. And what that means is that fund is able to get really cheap stocks right now that also are very high quality companies. And so one of the effects of low quality companies running up so much is, now you can get just as much of a value in some high quality companies. And so that may provide an opportunity for investors going forward to say, all right, I've got these more junky companies that have run up. Can I get the same exact exposure to value, but can I do it in higher quality companies? And as we're coming up on the 1 year anniversary here of the bottom. And so a lot of value investors are probably going to see, the period where they get to where they could take a long-term capital gain in their holdings. So this might be an interesting time to say, should I pivot more to a higher quality position?
Yeah, I think of Berkshire Hathaway or Pfizer or some of these big blue chip companies that, haven't performed nearly as well as a lot of other lower quality companies in the market, but, they're just super sound businesses with great fundamentals, and yet they largely haven't participated. So the other thing that I think you kind of pointed out in the article is a lot of times to get those high quality companies, they're not always cheap. A lot of times as you come up the quality spectrum, the valuations come up because you have to pay up for that quality business. But what we're seeing in today's market is investors rewarding a lot of those lower quality companies a lot more than they are some of these higher quality companies. And so I think it's going to be I think it's probably something investors should be thinking about and considering, particularly as we move throughout the year and the market sort of continues to do what it's doing here.
Yeah, like you said, this is not the usual situation. I mean, usually in order to get the higher quality companies, to maybe get the Warren Buffett type companies, I have to pay more than to get the Ben Graham type companies. But right now, and you still do in some cases, but right now you're seeing an opportunity to acquire higher quality value companies because of this run up, for cheaper prices. And, one of the ways I looked at it in the article is as I took the cheapest 10% of our database, both at the bottom and now. And then I said, within that cheapest 10% of our database, how many of the companies would be in the top 20% of our database from a quality perspective? So how many of these really cheap companies are actually high quality companies? And I think I don't remember the exact numbers, but I got something like it was 12% of that value universe was high quality at the bottom, and now it's something like 24 or 25%. So what we've seen double the amount of high quality companies falling in that cheapest decile. And so that's where the opportunity may be going forward, is we may be able to get higher quality companies now with the same, valuations.
But either way, we are very happy because we have a lot of, to some extent, low quality stocks in our portfolios, and we've been doing very well. But one of the things that we've actually been talking about internally is, do we start to make some small tweaks, modifications, if you will, to allow some of these higher quality companies to get in? And that's something that, as a firm, we need to decide in terms of the strategies we run, if we make some modifications to try to have our models sort of come more into this high quality camp. So that's to be determined, but that's something we're certainly kicking around.
Yeah, and to your point, any value strategy that has great performance off the bottom, who cares whether it had, whether it's because of value or whatever, at the end of the day, those returns are in your pocket. You got those returns. And people like to use factors to knock them, but I mean, you've achieved those returns and there's nothing to take away from them. But like you said, going forward, we're thinking about, all right, now we can buy higher quality companies at the same price. Is that something, as we sort of rotate to the point where we're at the 1 year anniversary of the bottom and a lot of these gains become long-term, is this something we want to think about is do we rotate to some of our higher quality value strategies and maybe away from some of these lower quality value strategies going forward?
So we'll put links to both your articles in the show notes. If anyone has any feedback for us, whether they agree or disagree, feel free to let us know. You can drop us a comment on YouTube or write us a review on Apple. So thanks guys for listening. We appreciate it.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.